Has the Fed lost control of the short end? Are they going to have to do more purchases, more QE as some are calling it? Are they going to have to announce something today to fix this plumbing issue?
Well, over the near term, they have the repo facility, so they could continue to use it. The question is how prepared and how much they want to surprise the markets at this meeting by announcing open market operations like growing their balance sheet or doing maybe a standard standing repo facility of some sort. And, I'm just not sure they're ready for that yet. Well, so they could continue to do open market
This all basically started happening yesterday. Yeah. They're in the middle of a meeting. No one here expects them to be that nimble. But if they have to make some adjustments, Jim, would now be the time to make them.
Yeah, they've lost control. The market is, if they want to have the market trade from between 10% and 2% every day, then they better do something in an hour to do this, a standing repo facility or some kind of liquidity injection. The problem is, the funding markets, the repo market, is 22% the size of the bond of the overall Treasury market. That's a 40-year low. It was 85% the size of the market in 2008.
Is it the flood of Treasuries, especially short-term Treasuries, that's part of the problem here?
Yes and no. That is what triggered it this week. But no, it shouldn't have. It shouldn't have. Years of Dodd-Frank, years of Volcker Rule, years of HQLA and LFC liquidity requirements. What that means is that they've shrunk this market down too small. This market is too small for the size of the financial markets we have now, and this is going to be a reoccurring problem for a long time. And we've been seeing it come. We've been seeing little problems with this market.
Little signs of it, absolutely. So they'll probably find a way to get more into the system. It's just a question of how they announce it and what form it takes.
Sooner the better.
Sooner the better, absolutely. So, Nisha, while we sort of weigh the Fed on the one here, look, 6 weeks ago, they came out with this pretty historic move. I mean, to cut rates when there's not a recession is a pretty big thing to do. Nobody was happy. He's used the language mid-cycle adjustment. The markets freaked out. And then the president the next day raised tariffs on China. So, I mean, should we expect a similar kind of risk around this meeting if it's not, quote unquote, dovish enough?
I think, unfortunately, the language will be a little vague because the Fed is put in a very tough spot. Economically here in the U.S., the data looks to be very strong. Recently, inflation has ticked up a little bit. The unemployment sector looks to be very strong. Manufacturing, we've seen a little bit of a slowdown, but that's being offset by a very, very strong consumer side of things. And then you take a look at the global implications. Global PMIs are slowing down.
Right.
What implications that have? So, I think the Fed is put in a tough spot because while they focus on a lot of the U.S. data, this doesn't warrant a rate cut in their eyes. But when you look at global uncertainties, which they have continuously kind of twined in their language, this is really what's prompting it, and that is not going away, the global concerns.
You can understand, Julia, the sort of conundrum, if you will. And by the way, they're making it pretty clear in case there was any doubt. The Fed speak has been vocal. I mean, we've had people expressing very different points of view. We had the infamous Bill Dudley op-ed where he said you should just let the president take his licks for this and kind of intentionally create worse policy outcomes. By the way, we just had Jamie Dimon speaking at a Business Roundtable event where he said a couple of interesting things on this front. One was no matter what happens with the Fed, he thinks trade's going to be more important. And again, those two are kind of linked. But he also said he thinks there's too much Fed speak these days, and maybe it's doing more harm than good.
I mean, that's always been the case. Structurally, we have too much Fed speak. I take my cue from Jay Powell. I think he was pretty clear at Jackson Hole that what they are engaged in is a series of insurance rate cuts. If they don't deliver what the market expects, it's akin to a tightening of monetary policy.
Which we saw last time.
Exactly. So I think he used the phrase significant risks twice since the last meeting. I think we see that either in the statement or in the press conference. I think that flags another rate cut beyond the one we're going to get today. So I think he's actually going to err on the dovish side. The whole idea of providing insurance is to get ahead of these risks, not to wait till they show up in the data.